Hey Bowtie Nation, Joseph Hogue here, and it has been a wild year for stocks, with our Bowtie Nation portfolio up 25%, beating the market by more than 11% so far. But not all stocks have zoomed higher. In fact, there are more than 400 stocks within 10% of their 52-week lows, and dozens hitting their lows every single day. But sometimes betting against the market and picking up these value stocks is the best hand you can play. In this video, I'll show you how to find those cheap stocks to buy for a contrarian strategy. We'll start with an easy screener for value stocks and then how to pick the very best. I'll then reveal the 5 value stocks I'm watching right now. We're getting started, but first I've got to send that special shout out to all you out there in the Bowtie Nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, all you out there in the nation know I'm a big fan of value investing. Maybe it's part of being a cheap ass to want the best deals, but value investing just makes intuitive sense, right? The golden rule of investing is buy low and sell high, so what better way to do that than buying stocks that are relatively cheap on those value metrics? But that value investing strategy hasn't worked over the last several years, not against those popular growth stocks anyway. The chart here shows the performance of both themes, value stocks in blue and growth stocks in red, and you can see for much of that time, value investing was the way to go, beating growth stocks easily over the period, but not over the last 5 years. Growth stocks have surged higher, and while value investors have made money, it has been a major case of FOMO. But there is a reason to believe that that dynamic might finally be shifting back around, that value stocks could once again outperform over the next few years, and I want you to be ready for that. I want to get to those 5 value stocks, so we're going to start in on the list, and I'm going to show you why that value investing strategy could outperform later in the video. To start my list, I used the screener on StockCard and first filtered only for companies with a market cap of over $2 billion. That market cap is the size of the company, really the value of all the shares in the market. And here, I want to make sure I'm sticking with those larger companies with the financial power to survive whatever is making them value stocks right now. Next, I'll toggle on this undervalued stock box, and this includes quite a few of the criteria that we look for in those value stocks. This is based largely on 3 things: the price to earnings and the price to sales ratio, as well as analyst price targets for the stock. Now, StockCard compares the current PE and the price to sales ratio with the average over the last 3 to 5 years. If the current valuation is at least 10% below that average, that's 2 of the 3 criteria. Next, if the current share price is at least 10% below the average analyst price target, then it triggers that good undervalued stock category. In screening for value stocks, I also like to filter for good cash availability, so a strong balance sheet here. And again, this is a safety precaution. I want to make sure that whatever the company is going through right now that's weighing on the stock price, making it a value stock, I want to make sure that it has plenty of cash to survive this period for that future growth. And now you see, that still leaves us with almost 600 stocks to research, so I'll go back into the screener and filter for a few more criteria. Now let's filter for companies with positive sales growth, so companies where revenue isn't the problem. I'll also screen for value stocks paying a dividend yield of at least 3% or higher, because we might as well get paid while we wait for the stock price to come back up. And then just adding those 2 criteria has narrowed our list to 78 stocks to research for our 5 to buy. I'll leave a link to StockCard in the video description below. Click through and then go to Portfolios in the top menu. You'll find the Bowtie Nation portfolio in the stock picks section. It's free to follow, and you'll get email notifications whenever I buy or sell from the portfolio. As a special bonus, I've negotiated an exclusive discount for everyone out there in the community. Use the promo code Bowtie Nation, that's all lowercase and one word, for an exclusive discount beyond the free trial. Plus, StockCard is going to double that discount throughout the rest of the year. Our first value stock here is Vertex Pharmaceuticals, ticker VRTX, a leading biotech in drugs for cystic fibrosis. And all you out there in the nation know, the first thing you need to do when looking at a biotech or a pharmaceutical stock is go straight to that pipeline. This is the stage of testing for indications the company is developing, and what's important here is, does the company have enough drugs at different stages of trial to grow its revenue? You see, the problem you'll find with most biotech companies is they get that one blockbuster drug that just boosts the sales. The shares take off, but then there's nothing left in the pipeline. Once the sales start declining from that one drug, the stock just dies, because what's next? And you can see here that Vertex does have some strong candidates in cystic fibrosis, 4 of which are already approved and earning revenue, but it does have a phase 3 gap, so that's probably what the market is looking at right now with the shares. The idea that it might be a while before those phase 2 drugs start getting approved and start adding to sales. Now, it is still a fairly strong pipeline though, and expanding beyond that core CF theme. Shares of Vertex trade for just 16 times earnings and 7 times on a price to sales basis. And that sales multiple is 47% below the 5-year average of 14 times sales, so definitely in that value stock territory. The company does have a strong balance sheet though to see it through that pipeline gap, with $6.7 billion in cash against just $893 million in debt. And this kind of cash-heavy, strong balance sheet is typical for biotech companies that have those high research spending costs and long stretches for drug testing, so they need that cash on hand. The average analyst price target of $258 per share is 43% higher from here, and even on a miss in sales, I think you get to the low 200s on these shares. We've still got 4 more value stocks to highlight, but I want to quickly share why you need to consider adding more of these value stocks, or why after 5 years, value could once again start outperforming growth stocks. First, and this is going to be one of the biggest themes over the next few years, inflation and higher interest rates. With the higher inflation that's already building, along with the economic recovery, most economists expect interest rates to keep on rising. The interest rate on the 10-year Treasury, the benchmark against which all other rates are measured, has almost doubled over the last year, from 0.85% to over 1.6% recently. And we all remember what happened when rates jumped during the first months of the year. Tech stocks in the NASDAQ 100 dropped 4%, and growth stocks in the ARK Innovation Fund plunged more than 11%. Most analysts believe interest rates will top 2% by early next year, and I think it could even touch 2.5% sometime over the next 12 months. That could be catastrophic for growth stocks and bring investors rushing back into that value once again. This next reason is a twofer for why value could outperform: slower economic growth and earnings growth next year. Trillions of dollars in stimulus money and the recovery have boosted the economy to growth of 5.7% this year, but not for long. The Conference Board estimates next year's growth at just 3.8% and then just 3% for the year after. That economic growth this year has translated to booming corporate profits, with earnings growth in every sector shown here by FactSet. Earnings for companies in the S&P 500 have jumped 44% this year. That's about 4 times the normal annual earnings growth, and it's pushed investors into those highest flying growth stocks. But that earnings growth is expected to come back down to earth next year, with the S&P 500 forecast to post growth of just 8.6% in profit, less than a fifth of what it did this year. And even that forecast is coming down. Just 2 months ago, stocks in the broad market index were expected to post earnings growth of 9.6% next year. Now, that forecast has now been downgraded a full percent and could fall even further. Now, that drop in growth of sales and earnings is going to take away one of the biggest arguments for growth stocks. In fact, it could take the growth out of growth stocks. Without earnings growth in the high double digits, the market and record high valuations starts to look a little shaky as well. That could mean more corrections where stocks sell off 5 or 10% or even more. In those scenarios, it's going to be the value stocks that protect your portfolio because, well, they've already sold off into that value territory. Next here, one of my favorites for personal reasons, Anheuser-Busch InBev, ticker BUD, is a solid value stock along with stable cash flows and safety if we see any market weakness. Anheuser-Busch is the world's largest brewer and controls 5 of the top 10 beer brands by sales. In what could signal a turnaround, shares jumped 11% on the third quarter earnings when Anheuser reported sales of $14 billion for 11% growth over the year. Both volume and pricing were strong here, especially across the company's premium portfolio of Bud, Corona, and Stella. Now, it's not quite the balance sheet that I like to see in value stocks, with just $7 billion in cash against $90 billion in debt, but this is a stable, cash-flowing company, so you'd expect to see a little bit more leverage. Shares trade for 18.6 times earnings and 2.4 times sales, which is a 25% discount to that 5-year average price to sales multiple. The average analyst target of $73 a share would be 22% higher from here, but I wouldn't be surprised to see if we get closer to that 52-week high around $80 a share. I'll reveal those last 3 value stocks to watch next, but I do want to warn you about one risk in value investing. The fact is that many value stocks, cheap stocks, are cheap for a reason. Just do not fall into the trap of thinking that you found hidden value in every value stock that makes your screening list. In fact, I'd say the market is right on 9 out of 10 value stocks, that there isn't as much value hidden in the stocks as you might think. This is where that fundamental research that we talk about on the channel comes into play. Finding those companies that really do have a competitive advantage and strong future growth. Because more often than not, those value stocks, It's just because the rest of the market doesn't have the patience to wait for that fundamental story to play out. It might be a great company, but some near term news is driving those shares lower. That means you're going to need the confidence in your investments that that long term picture will win out. And that confidence only comes with doing the research on a stock. That also means you need to be honest about the market's perspective. Why does the market think those shares aren't worth as much? And does it have a point? Now, that can be tough when you found a stock that you really like, but look at the other side of the story. And as you're working through your list of value stocks, you should be scratching off more than you buy. One of my favorite dividend plays is also a value stock. Energy Transfer, ticker ET, is one of the largest master limited partnerships, which means it owns pipelines through which oil and natural gas is moved, as well as the terminals where it's stored. At a $26 billion market cap and the size of the portfolio gives this one safety that you won't find with other MLPs. Nation, I think one thing you're going to see across stocks in the energy sector over the next few years is energy prices are going to stay fairly high, but companies aren't going to be spending on that new exploration or the new assets like they used to. They've got their eye on that long-term drop in demand for oil and gas, so they're going to be spending less on those new assets. That's going to translate to huge cash flow and higher dividends for these names. For example, Energy Transfer spent $5.5 billion in 2017 on developing pipelines and assets, but is forecasting capital spending of just $1.6 billion this year. That's resulting in earnings jumping from $7.3 billion 5 years ago to as high as $13 billion this year. Now, in those valuation metrics, you can't use the price to earnings ratio for MLPs or real estate stocks because they book so much depreciation that earnings really aren't a good measure of their profitability. Instead, you need to look at metrics like the price to cash flow, which is just 3.65 times here for ET. The average analyst target here is for $14.50 a share, which would be 49% higher from here, and that's on top of the 6.4% dividend yield on the stock. Teva Pharmaceuticals, ticker TEVA, is one I've owned for more than a year now and a strong value stock candidate. Not only is the company the world's largest maker of generic drugs, but it's also a strong pipeline of branded medications, along with blockbusters like Ajovy and Austedo, contributing to more than $16 billion in annual sales. Our shares have stabilized over the last few years, but two factors are really contributing to the stock's 80% plunge since 2015. Before 2017, the company was using an aggressive acquisition strategy, borrowing tens of billions of dollars to buy other drug makers. Now, those acquisitions failed to produce the kind of sales expected, and the company was stuck with as much as $34 billion in debt. Now, it's since paid that down to $21 billion, which is still high but very manageable. The other factor here is the 6-year litigation over opioid sales in the United States, with thousands of states' attorneys generals and local governments filing lawsuits against pharmaceutical companies. Now, the majority of these lawsuits have been settled, but Teva and Johnson & Johnson are still contesting some of those. And on that, the company just got its first really good news last week when a California judge ruled that Teva and J&J did not make misleading statements and aren't liable for the opioid crisis. Shares of Teva shot up 10% on that news, but are still in the value territory, trading for just 4 times on a price-to-earnings basis and just 0.63 times sales. For reference, the stock traded as high as 2 times price to sales back in 2016. The average analyst target of $11.47 a share is only 12% higher, but I think we see increased targets on this recent news and wouldn't be surprised if Teva hits its 52-week high above $13 a share. Alibaba, ticker BABA, is about the only Chinese stock that I would even consider buying right now, but it does check all those value criteria. Now, on the one hand, the group of companies here serves more than 1 billion users, up more than 140 million in the first half of the year. Alibaba amounts to 15% of the total retail sales in China, the second largest economy in the world, and grew total revenue by 34% in the June quarter, with 54% growth internationally. Analysts expect sales to rise 26% to $141 billion this year for $10.78 in per-share earnings. Now, that puts the stock at just 3.3 times on a price-to-sales basis and 15.8 times earnings. And compare that to Amazon, which is an almost identical business model that trades for 3.9 times sales and 58 times earnings, and you can see how cheap the shares really are here. On that comparable price-to-sales basis, Alibaba could be worth 18% more, and shares would be 267% higher on that comparable price-to-earnings basis. Of course, the wild card here is the Chinese government, and I think the recent crackdowns are more than just a socialist government trying to take more control. China is facing some serious economic problems with its property sector and wants to control capital flows as closely as possible heading into next year. That's why it's clamping down on cryptocurrencies and all these companies. Analysts have an average target for Alibaba of $246 a share, 42% above the current price, and an eventual run back to the $311 high would be 83% return. Check out the 2021 Bowtie Nation portfolio on StockCard or click on the video to the right and be ready for the coming stagflation bust, how to be ready, and the stocks to buy. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.